What if I told you the entire global economy is holding its breath, waiting for a single number? This is Kenya News Update today. Coming up, you'll discover why a tiny 0.01% move in a U.S. bond yield is causing sleepless nights from Nairobi to New York, and what it means for your shilling, your investments, and your future. Meet the 10-year Treasury yield. It's not just a number on a screen. It's the heartbeat of the global financial system. On Tuesday, January 27, 2026, that heartbeat barely flickered. The yield on the benchmark 10-year Treasury note rose less than 1 basis point to 4.058%. 1 basis point equals 0.01%. That's it. A whisper. A pause, but here's the twist. This silence is deafening. The bond market was closed for President's Day on Monday, honoring the leaders of the past. But all eyes are on the future and the decisions of the current Trump administration. Tuesday was a quiet start to a holiday-shortened week. Too quiet, because investors worldwide are frozen, waiting for delayed economic data that could change everything. The 30-year Treasury bond yield fell 1 basis point to 4.689%. The 2-year Treasury note yield was more than 2 basis points higher at 3.439%. These numbers tell a story of uncertainty. Yields move inversely to prices. When investors are scared, they buy bonds, pushing yields down. When they're confident, they sell, pushing yields up. So what does a flat line tell us? It tells us the market is holding its breath. But here's what nobody's talking about. This isn't just about America. When U.S. Treasury yields sneeze, the entire world catches a cold. Your mortgage rates in Kenya, the cost of government borrowing, the value of the shilling against the dollar, it's all connected to this 4.058%. And then something shocking happened. Nothing. The calm before the storm. Investors are anticipating the FOMC minutes on Wednesday. They will parse every word for insights on the last interest rate decision and future monetary policy under the current Fed leadership. They are also expecting a flood of delayed data this week. Housing data for November and December drops on Wednesday. But the big one? Friday, December's Personal Consumption Expenditures Index, the Federal Reserve's preferred inflation gauge. This number could dictate whether millions of Kenyans see their loan payments go up or down. Here's the part that will blow your mind. Traders are currently pricing in a 92% chance of the Fed keeping interest rates unchanged in a range between 3.5% and 3.75%. That's near certainty. The market has spoken. It believes the fight against inflation is in a holding pattern. But if the PCE data on Friday comes in hot, that certainty shatters. Imagine a world where U.S. rates have to climb again. Capital flees emerging markets like Kenya. The shilling weakens, import prices soar, your monthly budget gets squeezed. This is the high-stakes poker game happening right now. Ward 8C in a hospital has monitors. The global economy has Treasury yields. The beep is steady for now, but everyone is watching the screen, waiting for a spike. The implications are massive. For the Trump administration, stable rates mean a stable economy to build their agenda upon. For Kenya, it means breathing room, but the controversy is real. Some say the Fed has inflation under control and should cut rates to boost growth. Others warn that premature celebration could unleash another wave of price increases. The tension is palpable. 92% certainty. 4.058% yield. One delayed report on Friday. That's all that stands between calm and chaos. But here's the unanswered question keeping every fund manager awake. What if the data tells a story nobody expects? What if the calm isn't a pause but the eye of the hurricane? The 10-year yield flatlined. The world watched. And the fate of your wallet now hinges on a report delayed by a holiday. Do you think global markets are right to be so cautious, or is this fear overblown? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking news that connects Wall Street to your street.